Hello and welcome. My name is Benoit Paliquet. I'm one of the portfolio managers and the founder of Exponent Investment Management. And you're watching the risk and return component of these videos, the fourth quarter review. So let's get started. Fully invested investors, that means those that were fully exposed to equity markets, had a fantastic end of 2023 and really a pretty good year. As you're reviewing your account statements for your performance, which might sit somewhere, and for most of our clients that are, we had them for or been taking care of those accounts for at least a year, the account's performance would have been high single digits to low double digits. So let's call it 10% plus or minus. But when we look at the U.S. markets, so if we look at these markets, the S&P 500 and the NASDAQ, you're looking at 25 or almost 24% in Canadian dollar terms for total return for 2023 and 40% for 2023. Now, the two-year number on NASDAQ is still pretty crummy and basically flat, and the S&P 500 is up 4.1% in Canadian dollar terms over 2 years. So the volatility, really truth be told, what we saw in 2023 is a bounce back from such a terrible 2022. But the concept still remains. I mean, if you look at the accounts, why is your performance not the same as the U.S. components of the S&P 500? In other words, if you just focused on your U.S. portfolio, most investors didn't do as well as the index, and I'm going to explain to you why that is. So here we have the S&P 500. So it's an ETF called the SPYDER. SPY is a ticker. And you can see sort of the same wave that I showed you in the previous video around market results. And you can see the appreciation in US dollar terms of 24% from January until December 31st, or actually December 39th, or 29th, I should say. So great performance. But still, when you compare that to most people's portfolio, it was lacking. And there's a reason for that. And the reason is this. When you're looking at who generated the performance, you kind of get part of the answer. Now, we know that there's 500 names. In fact, at the end of the close, there was 527 names, and that's normal. Sometimes you get a little bit more, a little less than 500 names. 347 names in the index were up, 178 were down. Two of them, oddly enough, were exactly flat. So our 23.9% appreciation represents 920 points. Okay, that makes sense. But when you look at the top 10 gainers, if you will, in terms of percentage, you get some of the largest components of the S&P 500. In other words, these top 10 names, if you add up all these points up together, you get nearly over 300 points of additions or increase, if you will, which is basically 30% or a third of the total return. But let me say this another way. The top 10 names generated 30% of the return. Okay, some of us have some of these top 10 names. Why are we still short? Well, avoiding some of the weaker names certainly helps, but there's more to it than that. The reality is the index is oddly built. So here's the same S&P 500, but illustrated graphically. So Microsoft, Apple, Amazon, Google, NVIDIA, Broadcom, these are all sort of the largest technology names. Now, we know the S&P 500 is made up of roughly 28% technology. But what we're noticing here is that these big squares, and now the surface area of these names, if you will, in relationship to the overall S&P 500, gives you the weighting. So the bigger the square or bigger the rectangle, the more important, the bigger the weight they had in the S&P 500. So in 2023, some of the largest components had some of the best performance. In other words, Amazon, Tesla, Google, NVIDIA, Microsoft, Apple all had spectacular performance. In fact, higher than the 24% that I showed you. NVIDIA had 10 times that performance. Broadcom twice. So it begs the question, as a portfolio manager, you would not put Apple represents roughly 7% of the S&P 500. Same with Microsoft. Google's slightly behind, as is Amazon and Nvidia. So as a portfolio manager, most well-balanced portfolios will have 2, 3, maybe 5% in any given name, but they will never go up to 7% and certainly not have an industry exposure above, say, 10%, which would mean you would have maybe 2 or 3 technology names when the S&P 500 is made up of 28% technology. So you got to get the right names, which many of you do, but then you still have to get the same weight the S&P 500. So when you stop and think about it, the S&P 500 is built a certain way, that's fine, but risk management is nowhere near the conversation how the index is composed. Yet for us as portfolio managers, returns, we certainly get up in the morning trying to generate them, but we're also thinking about risk management, which index builders are not. So let's look at the S&P 500, but jig the names around a little bit, and we're going to look at what if the same 500 names, rather than be market cap weighted, which would mean, larger names making a bigger chunk of the index, what if each of these 500 squares were the same size? And that's really what we're saying by even weights. Now, same names, different weighting, all of a sudden, the S&P 500 equal weight ETF, which is RSP is the ticker, it only generated, it's still a pretty good number, 11.72%, but it's 40% of the return that the SPY or the index generated. So the weightings, not only is the name selection important, but the weightings. And most investors' portfolio, whether it's managed by Exponent or anybody else, will have should have a significant healthy dose of risk management into it. So the takeaway is that the index that we all know and follow is actually not a diversified way to manage risk the way a risk manager would do it. So the concept of risk minimization, the way a portfolio manager would do it, never makes it into the composition conversation of the index. So that's why most U.S. sides of portfolios didn't generate the 25% plus type of returns. If they did, then the risk management conversation needs to be had. Thank you very much for watching. If you have any questions or comments, feel free to send us an email. Thanks for watching.